Hello, my name is Rebecca Burt, and today I'm going to be working through exercise 5.7 from the textbook. In this question, we've been given some financial information for the Yost Company and the Noon Company, and we've been asked to find the missing amounts and to show the calculations. And so down here I've put in some simple formulas for addition, subtraction, and division to show the calculations I'm doing up here. So the first part we're going to work with is the net sales. To calculate net sales, we take our total sales revenue, less any returns, sales returns and allowances, and also sales discounts, although we are not working with any discounts today. So for Yost Company, we've been given sales revenue of $90,000, and we've been given net sales of $84,000. So we'll subtract that from the sales revenue, which gives us $6,000 in returns and allowances. For Noon Company, we've been given the total amount of sales, returns and allowances, and net sales. So we know that our sales revenue is less sales, returns and allowances to give us our net sales. So if we add those two numbers together, we will get our sales revenue of $105,000. The next section is gross profits. For Yost Company, we've been given net sales and cost of goods sold, and we need to find our gross profits. For that calculation, we just take our net sales of $84,000 and we subtract our cost of goods sold, which is $58,000, and that gives us $26,000 in gross profit. For Noon Company, we've been given our net sales and our gross profit. So we will take our net sales of 100,000, oops, one more zero, and subtract our gross profits of 40,000, which will give us $60,000 in cost of goods sold. And the last part is our net income, which is calculated by taking our gross profit and subtracting any operating expenses. So for Yost Company, we've calculated the $26,000 in gross profit, and we've been told that the operating expenses are $14,380, which gives us a net income of $11,620. For Noon Company, we were given our gross profit of $40,000, and we know our net income is $17,000. So we take our gross profit of $40,000 and subtract the net income of $17,000, which gives us total operating expenses of $23,000. The next part of the question says to calculate the profit margin and the gross profit rate for each company. We'll start with the profit margin, and I've put the formula here, which is our net income divided by our net sales, and it's given in a percentage. So I'll just put our numbers in here. We've got our net income for Yost Company of $11,620, and that would be divided by our net sales of $84,000. And we'll put our calculation down here of 11,620 divided by 84,000, which gives us a percentage of 14. For Noon Company, their net income was $17,000, and their net sales were $100,000. So we'll plug that into the formula down here. and that gives us 17% net or profit margin. Next, we have our gross profit rate, which is calculated by taking our gross profit and dividing that by net sales. So for Yost Company, we had $26,000 in gross profit, and our net sales were again $84,000. If we plug that down here into our formula, we get 31%. Oops. And for Noon Company, their gross profits were $40,000, and again net sales were $100,000. We'll plug that into our formula down here, and we get 40%. So the last part of the question asks us to discuss the findings from Part B. I'll start by just reading what it says profit margin and gross profit rate are. So profit margin helps companies decide if they are maintaining an adequate margin between sales and expenses. So this 14% here is telling us that Yost Company is making 14 cents on every sales dollar, and Noon Company is doing a little bit better by making 17 cents for each dollar of sales that they make. The gross profit margin helps companies decide if the price of their goods are in line with changes in the cost of inventory. So as we can see here for Yost Company, for every dollar of sales, 31% of that 31 cents, to every dollar is their gross profit, which means that 69 cents of every sales dollar goes to the cost of inventory. And for Noon Company, again doing slightly better at only 60 cents of every dollar going to sales dollar going to inventory cost, and 40 cents going to gross profit. The difference between profit margin and gross profit rate is that our profit margin tells us how much how much profit is being made based on the total expenses of the company, whereas gross profit rate only deals with the expense of the cost of inventory. I hope this makes sense to you, and if you have any questions, please post them and I will try to get back to you as soon as I can. Thank you very much for watching. Bye.